okay, hey, we're in December, right? And I promised you, going into the last 2 months, we would have a rally before the crash, and it's happening. So remember, in November we had this rally, and I told my gang members that when we start in December, we're going to have a little pullback first. You always do, because when you get to December, remember, the 2 months, why they're so good all the time is because they manipulate everything, the CEOs, to try to get big fat bonuses, okay? So you saw a November rally, right? Okay, now December, I told them you're going to get a little pullback at first, because at the beginning of the month, they do all these tax evasion stuff, okay? They trade for taxes. So about the 15th, you start seeing the market rally again. And then it's going to be over. Now, everyone's saying to me, Phil, you were right about the rally. When the market was dropping from July 2023 to October 13th, 2023, and you said we're going to have a rally, it rallied. You're right. But I don't think you're right about the crash. Well, I am. And I'm going to tell you why. First of all, because of that kind of lying. And here's something that was really interesting, talking about misinformation. Listen to this. Remember when they came out and they said the GDP grew by 5.2%? How the hell could the GDP grow by 5.2%? And here's the funny thing. The day later, the Atlanta Fed came out and said, oh, by the way, the fourth quarter, we're only going to grow 1.4%. Huh? How'd you get from 5.2 to 1.4? It's just like, you notice the first Friday of every month now, our labor market, the jobs number, they revise them every month now. They come in with a big month and they revise them. Used to be revised maybe twice a year, 3 times. The number's been revised, 9 months, 10 months in a row. That's insane. So it's being manipulated. So they're manipulating everything. They're trying to fight what they can't fight. We're going to have rates still going up. You're not going to get rate cuts. We're not going to go back to 2%. And they're doing everything they can, okay, to try to keep this market going. So again, when Santelli came out and he said this,
on the growth side, I have suspicions there, but
of course he got suspicion. And there was 3 of them that had suspicions. These are the guys who report CNBC, right? And I turned around and they said, well, God, that's good. They're being honest now. No, they weren't being honest. Don't fall for that. They were being embarrassed into telling the truth. Because remember, the conference board, they follow, for us, 10 key economic numbers, all right? And the 10 key economic numbers have been negative for 19 months in a row. That's a crash. That's what it's telling you. That's a crash. They were embarrassed. They can't come out growing 5.2%. Are you kidding? It's not growing 5.2%. And they proved it the next day, as I said. They said it's going to come at 1.4%. Okay. So the only way you're going to make money is by, again, like we do, you got to follow the money steps, not the fundamentals. The fundamentals don't work anymore. They just don't. They don't. In fact, the fundamentals, you could throw them out the window the day they went to discount brokerage. Because the day they went to discount brokerage, remember, when they used to work for you before discount brokerage, they worked hard. They would find companies, they would dig them out, and then they find a company that the CEO blew it, right? And now they got to reorganize it, and you go buy that company, you hold on it for years, you make a lot of money. And they worked hard to find that company for you. But you're paying about $250 for a commission. When they came in with discount brokers paying $5 and $10, well, they're going broke. They had to do something. What did they do? They say, well, why don't we buy the stocks first and we'll mark them up to our customers? Where's the fiduciary relationship in that? Well, that's what blew the fundamentals. That's why the fundamentals don't make any sense. I mean, you could look at price to book, price to sales, PE ratio. PE ratios mean something, but everything else, I wouldn't even look at. So my point to you is this. We're not getting the truth anymore. So I'm spending more and more my time working on my software that we designed, I should say, here at Phil's Gang, that follows the footprint of money. Here, let me show you this over here. Give you an example. So let's take when Google, you see how this started to turn red right here? This warned me that money was coming out of Google, and it was right. Look, it dropped. So we started to get in, and we switched from Google to ITA. Look at See how it's a nice job we got on that? That's what I'm saying. We don't care what the fundamentals of this company is. We didn't care. Just for example, like NVIDIA, right? NVIDIA warned us, look at this. Money was coming out. It was right. Boom. It dropped, right? Just like Google, right? It warned us money was coming out. It dropped. So we bought TLT. Look at that. Beautiful. And we bought DAL. Look at just starting to turn green. And then we bought ITA. Look at that, right? And so again, my point is, all this garbage talk, don't believe it. All right. Now let me back this up so you understand why the market's going to crash. The U.S., we're experiencing the biggest economic downturn since the recession, okay? And as I said, yet every flaw in the market and the economy is still trying to mask it with, we got a strong labor market, which is a bunch of nonsense. As I said, the payroll and employment, it's half of what it was a year ago. So it's a pure lie. Now, under Biden, since January 2021 to 2023, 15 to 25% shrinkage in our paychecks, in our savings. The average person now is losing out of his pocket $4,500 as opposed to getting $7,500 from Trump. But here's the real one. I want you to understand real gross domestic income. That's what everybody looks at. Real gross domestic income. What that is, you measure, okay, what are my wages? What were my salaries this year? My bonuses, my interest income, my dividends, my profits from a small business if I own it, or I have a partnership with someone, and I put that all together. What am I doing? How well am I doing? Well, the historic is 3.6%. Biden blew it. Under Bidenomics, it dropped 38%. 38%. Down to about 1.3%. Under Trump, I'm not here pushing Trump. I'm just pushing numbers. Under Trump, he had 3.98. That was above 3.6. So my point is that everything Biden said is not true. And then when Biden became president in 2021, okay, and remember this now, when he became president in 2021, Americans had total liquidity, cash, of $16 trillion. I.e., bank deposits, money market funds, savings, money in your checking account, $16 trillion. You know that there was so much inflation, it dropped $2.4 trillion. $2.4 trillion gone of that $16 trillion. That's a historic drop. We never had a drop that big. Extrapolate it, that's a 50% inflation. That tells you it's the truth, 15% inflation. That's our inflation number. That's why we're going to have a crash. We can't withstand that. Now, the other thing, since 2021 to 2023, Main Street, Americans, you and I, we spent 75% of our paycheck on necessities, for God's sakes. Gasoline up. Now, these are real numbers. These are numbers from January to October this year. Gasoline's up 37%, shelter's up 18%, groceries 20%. You got airfares 21%. But let me put it this way here, so I'm not wasting time. The three biggest things: gasoline, shelter, and groceries take about 75% of our paycheck. That's inflation. That's really bad. And because of the inflation, it's eating up the money that people have, the discretionary money after they pay their taxes and so forth. And that's why manufacturing is down 13 consecutive months, and factory orders are down 3.5 years. And the big one that's down is durable goods orders. That's the big one. That's the one you need, because that's forward-looking. Durable orders tells you how good things are in the future, because durable orders is when you buy a big TV screen, or you buy a refrigerator or washer, or machinery or equipment. And if that's good, the orders are good, it's telling the CEO of a company, hey, things are going to be good for the next 2 years. Okay? If it's bad, it's telling you the market's going to crash. And guess what? Durable goods orders is the worst ever. Worst ever. So all this stuff, and that's why I get so mad when I hear from Biden how great manufacturing is.
Manufacturing rebounding at a faster rate than in the last.
It's just such a lie. So again, when you think about it, this market, here's another thing. When Biden came into office, remember what he did? He took over 6.5% economic growth. 6.5%. That is fantastic. Because of the hatred that he and the Socialist Democratic Party had for Trump, they're going to destroy anything he did. And you know that. And they did that by what? Destroying our independence, our oil and gas independence. We were energy independent, and they blew that up. They didn't care. Think about what they did. And this is why the market's going to crash. So 6.5% growth rate, the only time you increase your money supply is when you got to push your growth, that you're stalled. If you go and push money into something that's already growing, what happens? You blow it up. That means inflation goes up and the dollars in your pocket go down. Prices go up, your dollar go down. So what did he do? He comes to the office and he pushes all kinds of money supply. And then 24 months ago, just 24 months ago, he increased money supply by 42%. Are you kidding? But yeah, now the economy sucks. But by putting another 42% in, that's why you're never going to get back to 2%. In other words, we have so much liquidity sloshing around. And this is the funny part. He gives all this money to the banks, increases 42%, and then he shuts the banks down. He said, don't lend. Tighten up. Don't lend. So the economy can't absorb that money. So here you got all this money, and the banks aren't allowed to lend, and the money's sitting there stagnant, and that means the dollar in your pocket goes down and prices go up. We're not going to go back to the 2%. That's why the market's going to crash. This is the stuff that's going on. Nobody wants to talk about. But the other thing, too, remember, is that the PE ratios of these big stocks that have been driving this whole market. Remember, you got just 7 stocks driving the S&P 500. 7. And the PE ratios are insane. They're nosebleed levels. And that's what happens when you have too much money that's going into the economy like that, and you get all of a sudden the PE ratios will start going up. PE ratios will start, and they're insane. So right now, the money supply he's put in, instead of spurring economic growth, he's spurring more inflation. You're not going to get back to 2%, I'm telling you. You're not. So, and then remember the Conference Board, following those 10 key economic indicators, they're showing us the breadth. This is the worst breadth we ever had. The S&P 500, for God's sakes, we got 7 stocks pushing up the whole market. We got 8,000 stocks to trade every day, and 7,500. We can't make a new high. We have more lows than new highs. What more do you need for evidence that the market's going to crash? That's the worst breadth we ever had. And then you take the economic numbers we're just talking about; they're down in the toilet. So again, the people don't understand this either. That remember. The only reason why everybody was out buying is because, remember, he put moratoriums. He said, you don't have to pay your student loan anymore. You don't have to pay your rent anymore. You didn't have to pay your mortgages anymore. You didn't have to pay your car payment. Remember all those moratoriums? That money has just that's depleted. Remember, savings went from an average of 8% to 30%. And then he comes in, look how great the economy's doing. Great. No, the economy wasn't doing great. The economy was terrible. And so what he kept doing is he kept on pushing more money, more money, more money. And so people were out there, they didn't have to pay any payments. So, of course, the savings went up to 30%. Well, it's depleted now because now you got to pay your student loan and everybody else got to go to work. So here's what happens. Savings is now at 3%. Isn't that something? Savings at 3%. That's why the market's going to crash. So, and going back to the last thing I want to finish up with, if the economy is doing so good as they say, and everything's so strong as they say, and everything's wonderful, we're going to have a soft landing, why is it that the Black Friday we had, that the sales increased over a year ago, I think it was 7%. But that's nothing. And by the way, the sales didn't increase. If you look at the number of units sold, they sold less stuff, less items than last year. The reason the sales were up because prices are up, because inflation is up. Like I said, gasoline is still up 37%. grocery stores, you go to the grocery store, still up 25%. So what happened on Black Friday is that we had a 42% increase in the amount of people who say, I'm going to use the program, buy now and pay later. Wow, 42% increase. People, they're out of money. And what they did, after all that savings was gone, it went from 30% down to 3%. Now they're doing withdrawals on their 401k, withdrawals on their home equity, everything, withdrawal. Matter of fact, it was the emergency withdrawals from 401k have never been so big. So lastly, let me show you a chart so you understand what's going on. Okay, look over here. You've seen this chart before, but I'll end with this. Remember this. Here's 2009 down here. This is when we started to have the big rally, right? And interest rates on the 10-year Treasury were 1.6%, 1.5%. And that's why we rallied. And the 10-year Treasury, the 3-month Treasury was 1/10%. Banks were loaning to each other at 0, right? So what they did were giving mortgages at 2%, 2.3%, 3%. But guess what? Every mortgage they're losing money on. Remember, in 2008, when the stock market crashed, only 14% of the mortgages were banks losing money on. They're losing money on 100% of them. Not that they're going into default because of what Biden did with all his money and liquidity and everything else. Interest rates, to fight that inflation that he created, interest rates went upward. Now, the money that they're sitting there with all these loans that people are paying 3%, and the bank is paying 5% to service the 3%. We have 180 banks. Remember that. We got 180 banks. These are your regional banks. Remember, we had 3 regional banks go down. And then after that, they created a pool of money so that the 180 banks, if a customer came in and wanted their money, that would be there for them. Because the 180 banks were in the same situation. They had no money because they're losing money on every loan. They have no money. So when you went to get your money, they had to say, SVB had to say, well, we don't have any money to give you, I'm sorry. Well, Powell panicked, Biden panicked, and they set up an account where people could, where they set up an account where these 180 CEOs can go in and borrow money, the funding program, bank term funding program. And so they went in and they said, what we'll do is we'll give you 180 banks, okay, so that you don't end up like Silicon Valley Bank and Republic and Signature. We're going to give you a bank term funding program. They did that, by the way, in 2008. It didn't work out very well, did it? So they're doing it again. So again, this is why everything you look at, how could anyone say there's not going to be a crash? So take a look at my chart here one more time. I'm sorry, I get so upset. So understand, we rallied because the yields were at 1.5%. Every time we pulled back here, we pulled back here, okay? We pulled back here. What'd they do? It's because the rates on the 10-year Treasury started to either go to 4% or invert. The only way they could create a rally is if they kept the 10-year Treasury at 1.5%. Now, remember what happened right in here, right there. That's where the banking crash occurred, right there. Yields were at 4%. So they sat around and said, well, how are we going to get the tech stocks, to go up when the 10-year Treasury yields are 4%? Let's put a pool of money together and have our 5 biggest banks buy Apple and Microsoft to push it up. That's what they did. That's how they rallied the market up to where they are right there. That's how they did it. So now, and guess what? We pulled back again. Now we got this other rally. So every time the market pulled back and had a crash, it was because rates were above 1.5. We're still at 4 plus. So that's another reason why the market's going to crash. I could sit here all night and tell you why the market's going to crash. But you've got to be patient. You've got to be patient. Keep watching IWM, the symbol IWM. That will help you. That's the small mid-cap stocks. If that starts going down severely, then you know the market's ready to follow it. Okay, I don't want to take any more of your time, so please, I hope you hit like and subscribe. I hope you enjoyed this. To join my gang free for 10 days, so you can learn how the market works, learn how to short, learn how to buy. Just click the link in my bio. And at the end of 10 days, you decide not to stay, that's fine. But if you use our knowledge and you make a little bit of money, just send a little check to a couple bucks every now and then to St. Jude, okay? St. Jude's a great, great, great place. I know all about it. My son had cancer. We were fortunate to have enough money. We didn't have to use St. Jude, but we know all about their program. We support them. So I hope you send a couple bucks to them, okay, if you don't stay with us. But I hope you do. And by the way, a lot of people say, I just don't have time for this. I don't have time. Don't tell me that. You can't find enough time to do the S&P. All you have to do is buy the S&P. We do all the work. We tell you when to buy, when to sell, when not, when to add. All you got to do is have your online broker and send. If we tell you to buy, you buy. Tell you to take profit, you take profit. We do all the work. The S&P. If you were with us in October to now on the S&P, you wouldn't have to do it. You were up about 10%. So you'll always be making money with us on the S&P. And when the market goes down, you're going to make money in the S&P because you're going to know how to short. You can't say that for your 401k. That's about it. So again, if I don't see you, please have a nice Christmas, okay? A great holiday, a new year. And I really hope you enjoy this, and I really appreciate your support. And I hope that you continue to, tune in, okay? All right, see you on the charts.